back. I feel like we're at a pivotal point in the housing market that we should start doing weekly uh, inventory watch updates to kind of keep track of like where is inventory going because it's uh, really low. It's at probably in a historical low that we've seen. And so I feel like if you haven't watched my last video, we kind of talked about affordability and where that's going. And I feel like we kind of need to watch both affordability and inventory kind of on a weekly basis just to kind of see like, are we going to break through this weird like low inventory, low demand? And we need to break through and either one has to go in order for this market to kind of shift one way or another. So let's kind of dive into the data that I have prepared for you guys. Okay, so this is what we got. Inventory Watch 2023. We're starting here. It's August 20th. And I want to go over the data and we'll set our baselines for this inventory watch and kind of from here on out, every week we'll have an update of like where inventory is going and we'll set our baseline today. So I wanted to start with rental inventory. I feel like this is one that nobody's really been talking about, and we have to understand what's happening here in the rental market in order to understand what's happening with affordability, in order to understand what's happening with buyer demand. So it's all kind of related. And it, as you can see, inventory, this blue line is active listings, right? So rental inventory has been nothing but going up since 2021. We did have a decrease in inventory in the spring, which is kind of normal in a regular market where we see people looking to move out of their rentals or to move in the spring. That's our peak demand season for buying and renting because people want to move and get into their new house in their new school district before school starts, which is usually in the middle of July to the beginning of August is when all the schools start to start here in the Phoenix metro. So this is kind of a normal dip, but let's take a look at it a little bit deeper. So what I've got is long-term rentals, and it excludes short-term vacation type rentals, Airbnbs. And so these are rentals where people are going to live, not to vacation, not to come and visit, but this is local inventory. And with the graph that I just said that it's been increasing since 2021. We started 2021 or two years worth of data. This graph starts at probably around 1600 listings at any given time and slowly has been rising to where we're at today. We're at 4.7 thousand rental listings on the market. So we went from like 1600 listings to almost 5,000 listings on the market. And demand has not picked up that much. This gray line is pending listings of like how many people like went under contract with a rental. And so we're seeing that the pending listings, stayed, let's see, this is probably again 1500 and we were under the 2K mark until about July 2022, and we started seeing more people coming to the rental market July of last year, and it's kind of remained like demand kind of has remained around the same line here if we were to average this out. And so we have the same amount of renters for about the last year renting single family homes. Now there could be more rental demand going into apartment complex. I do not have that data. And so like that is something to consider there. And then new rental listings coming to market. We can see that it did start to go up and then it kind of trended back down, which is probably why we started to see the total listings come back down because demand didn't really do much. So, but we are now seeing new rentals coming back to the market and starting to increase, which is pushing this back up. Now, affordability, let's talk about what prices are if you were to rent a single family house versus an apartment. Single family homes, like our average, I just pulled like the last 60 days numbers, and the average rental price right now is about $2,400 for about 1,700 square foot. So most apartments are smaller than that. Like, you know, if you wanted a 2 or 3 bedroom apartment home, that'll probably cost, you know, anywhere from 19 to $2,200 for an apartment for like for 3 bedrooms. But if you're getting a 2 bedroom, you could do 18, you know, they range in price, but I would say the average 2 bedroom is probably 18 to 1900 right now. And so you can see that there's an affordability gap between like 1900 and 2500, right? That's like $600 a month in payment difference. So when we're talking affordability, we need to understand the numbers and what this means. And so again, I'm setting the baselines here of active listings for 4.7 K, and then new listings at 3.2K and pending at 2.2K. So will be our baselines, and we'll go from here and just kind of see where are we doing weekly, and are we on trend to either meet, beat these or get below them. So that's where we are, baseline rental inventory. The other thing I wanted to talk about on this graph was that we do have a divergence that started, and a divergence means that we have inventory picking up and going in the up direction, and we have demand, we have pending listings going down in the other direction, right? So people going under contract, we're going down. And so will this continue? I don't know, but the divergence there, this means that market shift could be coming. We've been remaining flat here. So it'll be interesting to see if more people decide to rent houses versus purchase houses. Like we'll see this go up. But we're also starting to see inventory go up. So if we see this continue to stay flat and inventory goes up, because it's been relatively flat, like between, you know, 2.1 and 2.4 thousand people renting homes every month. If we see that remain flat, but inventory continues to rise, then that means that price cuts will happen and rentals could get cheaper. And if we see demand continue to fall and the divergence gets bigger, then that means price cuts will definitely continue to happen, and like rentals will get way cheaper, right? If demand does kind of cycle up and inventory cycles up, then we may just like hold, right? The cost to rent will hold kind of like where we're at. And so that's something to consider. Let's take a look at for sale inventory. So these are the number of listings that we have here. The blue line here is number of total active listings on the market, and the green line is the total of new listings coming to the market. You can see that August of last year, we kind of had a dip, starting like inventory started to decrease. Home sellers weren't really putting their home in the market. And we had a little bump going into January. This is our spring buying season, and you can see that the sellers just didn't come to the market with the inventory. It usually like will kind of peak up and round off and then slowly come back down, but we didn't have that happen. It just kind of remained this flat below 10,000 mark coming to the market. And I think what we'll start to see, what we usually see, is this starts to decrease after August, right? Everybody kind of, that spring buyer demand has happened. Everybody already went and bought their house because their kids were going to start school, and that rush kind of happened. And so a normal decrease in new listings to the market is what we usually see. And we're kind of staying flat right here. So the question is that will we see a big drop in the fall, or will we just kind of remain low because we're already low? That's the question is I'm asking myself and wondering what's going to happen here. Which is another reason why I want to do these weekly kind of like micro checks. The other thing that we're starting to see, that the total number of listings actually is starting to balance off. And so I feel like it's gonna balance off and you know, start to slowly like ramp back up, is kind of initially in my mind what I thought would happen. But the question is that like how how are they calculating this? This is the data from the MLS. And so like I have a couple different things here. Like here's our baseline. This dot here, the MLS says is 13,400 and so houses. When I checked, there's two different ways to check it. One is pure active onlys. And if that's the case, then it would be where we're at today is 11.8 thousand. And that means we tick down. However, there's this other number here that's 14.2. They consider, sometimes they consider active listings of like they're active on the market and then they're active with contingencies, meaning like they've got a buyer that's put an offer in, but they're still looking for backup offers. So it's still technically active. And so if that's the case, then the number is 14.2, and this number is actually going to tick up. So what I need to do is I need to verify which set of numbers that this line is tracking, and I'll know that in a couple of days. I'll have that data, and so we'll have the update next Sunday to verify which direction we actually went in. So I'll have that verification for you guys, and I think it'll be interesting, like because right now it's like, did we tick up or tick down? I don't know, because I need to verify that. So if I think it's a good idea, if you're interested in understanding this too at a micro level, like subscribe to the channel and get the alert so that Sunday when I post the new data set, like we'll know which direction we went in. And then we'll start tracking from there at a micro level, because I'll know like, am I just tracking actives or actives contingent to actives? So that's a thing. And then the number of new listings. Yeah, we already talked about that. So are we ticking up? If we are starting to tick up, like we have that divergence, right? Because like this will start going up, but new listings coming to the market is going down. And that would signal, if we have that divergence of total listings going up, but new listings coming to the market down, that will signal that demand has fallen even below the amount of new listings coming to the market. If it doesn't, that means that buyer demand has remained the same. So I'm interested in seeing which direction this is going to go in for next week. So hit that follow button. The other thing I wanted to talk about was the average sold price for that same amount that people could rent for, right? I said if somebody were to rent a single family home and the average price was $2,400 a month in rent for about 1,700 to 1,800 square feet. That's looking like a $450,000 house right now, to get that similar square footage. And that would mean a base payment. And this doesn't even include property taxes, homeowners insurance. It doesn't include any of that. It's just like base payment of like $2,497 to $3,000 a month, depending on which loan program you get, like how much you put down. So if you tack on property taxes and homeowners insurance on top of that, you're probably looking at a base of like $2,800 a month. So if you could go rent the same house for $2,400, but you bought in at $2,800, like what decision would you make if you were strapped for cash? Would that $400 be a extra like boost in your well-being of like living and having an extra $400 to go out to eat or to go, take your kids somewhere special versus, not having that cash, right? It could be a car payment. Like who knows, for some people that $400 is very, for anybody, $400, I think is a lot of money extra at the end of the month. So, I think that's what we need to consider when home buyers are coming to the market looking at should I buy or should I rent, or there's still benefits of home ownership. So like having a $2,800 mortgage might not be so bad if home prices continue to rise, because you might lose out on getting in, and you could always refinance at a lower rate when the rates do come back down. But it's a risk, right? With everything, it's a risk. When we're looking at new inventory, I was able to get this data specifically. So new inventory this week was at 1634 came to market this week. Last week it was 1692. So definitely new inventory you know, ticked down for this week again. And so like, if we're going to continue seeing the inventory tick down, then, you know, are these going to be like, will we even have that divergence here? In order for this market to shift, we need to see a divergence between total actives and pendings. So speaking of pendings, let's go over there. This is pending inventory. So the pending inventory is actually the gray line down here. And we can see that pending, the amount of people who pended a property, who put an offer on a property and it got accepted, it has been decreasing since April. So April was like the crossover here. So we had less in May, we had less in June, and we had less in July, which means that buyer demand has been decreasing since April. Little small ticks here to there. So pending inventory from last month, like between June and July, this is 3.6%. And so this was a smaller one, this was a smaller one, but this is probably the biggest one I think that we've seen. So buyer demand has fallen again, which means that if depending on those numbers for actives, like if that number is really 14,000 going into next, like, sorry, this 14,000 of actives, right? If this is true, then we're going to have that divergence. But if it's 11.8, we probably won't have the divergence. They'll be going down together, converging like at the same rate, right? So, and so that would keep us at this weird like market that we're in, where it feels like a seller's market, but like not really, because it's just inventory constrainment, because buyer demand is like not there. Like the buyers are still not there. And so this is really interesting and something really interesting that we need to watch. Because eventually buyer demand is going to fall enough that inventory is it's got to start to rise. I don't think that they're going to be reducing the interest rates anytime soon. And that's really what's causing buyer demand to fall at the rate it is. Now, it is normal to go into August, September, October and have buyer demand fall because, again, you know, we usually see buyer demand tick up in the spring. And look, here's December, and like really spring in Arizona is January, right? So like that's when the weather's cool and people are out and about between January and May, really, I think, as most times things go under contract. We didn't have a huge spike. Like it was a very lull in demand, but with inventory coming down the way it was, it made it feel like it was a seller's market. But when in actuality, it really wasn't. This is a low amount of buyers in our market, but we had even lower inventory. And so it's just like, it's just bizarre. So that's where we're continuing. And I think like we might be bottoming it out on active listings here real soon. And I think we're going to start to see inventory start to rise a little bit because buyer demand is coming down. And it's got to come down enough to create that divergence. So I'm interested in seeing next week. So come back with me next week. I want to see if there's a divergence starting. And then going into pricing, right? We're starting to see prices actually come down, but not because there's too much inventory. It's because buyers can't afford to make an offer on a more expensive house. And so interest rates have ticked up, right? From like 6.7 to 6.9 to 7.2%. And every time it ticks up like that, that means the buyer's pre-qualification is for less. So if they were pre-qualified for 475,000, they're now only pre-qualified for 450. You know, they're coming down. And this right here is interesting to see that even though like inventory is coming down, I think we will start to see prices come down as well because buyer demand is decreasing because interest rates are higher. And like, that's just what we're going to start seeing. And so this, this gray line right here this is pendings. And so what pendings tell us is like what's happening now will predict like what's is going to happen by the end of the month when it actually closes, right? And so the pendings, you can see in June, the pended amount was 568,000. Now, what actually closed was closer to 580,000. There's a big gap here between like what actually happened, but that's because there was such low inventory and there was a little bit more buyer demand, going into the end of May into June. And so like that caused what to actually close to be higher than what went under contract. And because there was like probably multiple offers, because inventory is so incredibly low. Now, what we saw in July was different. We actually saw the pended amount coming down to 553 because interest rates went up, right? And we're like in the low sevens now. And so every time it ticks up, like that means buyers can afford something less. And so it was like 6.9% or 7%, and now we're at 7.2%. So I would predict that this is going to be down again when the August numbers come out, because the interest rates rose again. And so this is what's going to drive prices down, not a lot of inventory. Because the buyers just can't afford it. The banks won't pre-approve them for those high numbers. So what we saw was the gap is filling. So yes, it ended at 553, but we just saw it in that last slide was that the buyer demand has fallen, right? So there are less buyers, which means there's not that multiple offers driving all of this up. So there's not as many buyers competing. And so you're not going to see the big gap between what the pended price was and what actually it will close for. And I think we'll start to see this kind of shift a little bit for the next, again, the August numbers. Today's August 20th. And so the next reporting is August 23rd. So I'll report that next week on Sunday, and we'll have these fresh month over month numbers. But this also gives us the baseline to start checking these weekly as well and kind of seeing like where we're going to end things. So this is all super interesting. I also did an analysis of like how healthy is our market right now. And so what is the makeup of what type of buyers do we have? So in the last 60 days, 50% of or 48% of our market was a conventional buyer, which conventional buyers usually have a little bit higher credit score. They put anywhere between 5 and 20% down or more. And so it's a pretty healthy like debt to income ratio. And so like that's 48%, almost 50% of our market are conventional buyers. Now the next biggest number was cash buyers. So 50% conventional, 20% cash. So it was 19.8% cash. So 70% of our market is a really healthy conventional cash buyer. And then the next one is 19.5% was FHA buyers, which is still a pretty healthy buyer. It's very, very well regulated right now. FHA is not doing anything crazy. It's just a little bit lower down payment. You could get into an FHA loan with 3.5% down, and you could have a purchase price. I think it's like well over 500,000 to qualify for FHA. And sometimes they're able to work with a little bit lower credit score too. So like with conventional, I think it's like 680 or more. And whereas like with FHA, you can get in at like a 640. So the market is pretty healthy. 50, 60, 70, 80, 90, 90% of the market is very well qualified, financed or cash buyers. And then we have VA, which is another 8% of our market, is still very healthy. Like VA doesn't do anything crazy. And so that is helping our military get into housing for 0% down, which is wonderful. And so 98% of our market is like that. And then the other part of the market is like our outliers, right? Where the sellers are financing, where we have 1031 exchange for investors, like, rolling properties over and things like that. That's a very small outlier part of our market. But for the most part, our market's very well cash and conventional, well qualified buyers. So that's kind of where I'm going to leave it today. Join me next Sunday, and we'll have the updates on the new ticks. And let me know if you have any questions or any particular markets. If you want to see like Gilbert, you want to see Chandler, you want to see like specific parts of the valley, happy to bring that up in the next video. Thanks.